Hello, everyone. Thank you for taking the time to come and join us for this webinar today. Just going to wait a couple of moments as people are trickling in. Okay. Hi, everyone. Thank you again. So you're very welcome to today's taster session, which is hosted by us in Trinity Executive Education. I've been in touch with you. My name is Jane, and I manage recruitment and enrollment for our programs here, for our open enrollment programs in Trinity. Thanks for taking the time today. So what this session will offer is a preview to the postgraduate certificate in leading and implementing sustainable finance, which begins this October. If you would like to learn more about this PG Cert, you can visit the webpage and I'll pop the link into the chat. And please note also that the course is 50% funded by SkillNet for eligible applicants. Okay, so to the main event, I'm delighted to have Kevin McConnell with us, who leads out on this module on implementing sustainable finance. Kevin brings over 20 years of corporate market experience across investment, banking, and advisory, working with institutional investors, private equity, and regulators, amongst many other things. So with that, I'll hand over to Kevin to lead today's session, which is entitled The Global Battle for ESG, Implications for Investment and Strategy. Kevin, over to you.
Thanks very much, Jane. Yeah, so it's an incredible environment. Now, this session, it's a little bit of a prelude, obviously, to the module that I'll be delivering in the postgraduate certificate later on in the year. And like one thing that is absolutely certain, that things will change significantly between the time that I talk to you today and what's going to happen later on in the year. So we're at an extraordinary time in both financial markets overall and the change and radical change in US trade policy, and the background economic environment that will bring, and also the impact on particularly the area of ESG, which has been categorized as I suppose a key target from the current US administration in terms of their movements against it. So what I'm going to do today is we're going to talk about financial markets overall, what's happening just generally, where the key areas of concern for investors, just setting the general environment. Then we'll look at specifically the type of areas that the rollback in ESG in the US and how that's impacted some of the global environment, and where does it leave Europe to a large extent in that regard, both from the banking and the asset management world. I'll then look at some of the changes that we're seeing in the approach that Europe is now adopting, given the fact that it's probably, to a large extent, right at the leadership end of the ESG momentum, and obviously fighting climate change. And then we'll talk about some of the numbers that we're involved with in terms of the macro numbers that we look at when we implement a consciousness around what's the impact of climate change will be, just generally. Well, where are we at now at this stage, and what's the impact from a financial markets perspective? Because to a large extent, ESG can be seen from an ideological perspective, but fundamentally, it's becoming certainly climate change is becoming very much more of a financial risk within the financial system, both in the banking and the asset management world. And then finally, what I hope to do is a type of probably give you a bit more of a run through on what are the strategy takeaways that you might look to see where your organization is within that environment, whether you're in banking, whether you're in investment market side, or whether you're in the general corporate environment. So we can start without really giving a type of quick look at what's going on just generally, and you can really see across the main categories: interest rate policy, cost of living, and inflation in the US and Europe, the financial contagion risk that now is probably increased in the last number of months. We've got a very strong dollar movement. We've got a US deregulation, high levels of uncertainty, and obviously we've got the political backdrop changing in the States so much, and obviously that having an impact on energy security. So ESG is a massive area in terms of the consciousness of where investment strategy needs to sit. Between the Europe and the US, it's somewhat being pushed aside because of what's going on really in the macro environment. And obviously, a lot of that is down to the tariff environment. We were just new highs in financial markets today in the US, or in the last couple of days. a 23% rebound since April, a big charge from big tech and industrials leading, but we're starting to see that signs of that rotation out of that. Now, a lot of this, to a large extent, is actually very poignant that if you look at the companies that are very exposed outside the US rather than to the US economy, they've been leading the market. And to a large extent, that's been probably a big feature of the last recovery since Liberation Day. The big sell-off that happened afterwards, the big recovery has been dominated by companies that are more exposed to outside the US. So if you look at the rebound since May alone, so after the initial jump in the markets from the somewhat rollback that we saw in the US administration from tariffs, we've seen an 11% increase in the S&P, but actually companies that are heavily concentrated in the US have actually only risen by about 5%. So there is a serious concern about the development of how the US economic mix is stacking up at this stage with the impact of tariffs feeding through. What we're seeing in the ESG side, obviously, and not surprisingly, just generally the movement away from ESG in the first quarter in this year. And it's hard to underestimate how big the damage has been in terms of the policies that have been adopted by the US administration thus far. And I'm going to go through some of the specific elements of policy that have been instigated. But within that backdrop, we're obviously looking at, expectations for where we think the market's overall on. Now, tariffs, as in, their current form would see a 10% shaving off of S&P earnings. So bizarrely, the financial markets has effectively dismissed the impact of tariffs, even though we've now have, since the start of July, and obviously announcements over the last couple of days as regards European tariffs, we're now back up to the same level of political and economic uncertainty that we were back in April, yet the markets still haven't reacted. So they are obviously, to a certain extent, there is a calm. The question is, is there a storm coming, or where are we as regards minding the gap when all of these tariff impacts start to feed through to the impact in the US economy? What we have seen is very, very strong movements towards the euro against the dollar, a little bit of weakening in the last couple of days, but we're starting to see stress tests being done in the dollar-euro relationship up around 130, so substantially higher from these levels, given the march that we've seen in the euro over the last number of months or so. And one of the things that's probably dominating investor psyche overall, and this is very important from the ESG perspective as well, about 75% of the world market indices in terms of capital markets in equities is US equities. So effectively, if you take out the Magnificent Seven, they make up about nearly 25 to 30% of the global equity tracking of global stocks. So if you buy a global equity index, you're buying 75% of the US economy or US market effectively in that. And that obviously has an overbearing impact on everything else that we're seeing in the market. So the weakness of the dollar is obviously having a bearing on financial market performance overall. So there is quite a few dichotomies here. Now, the biggest question that we have as regards the US economic outlook is how much of all these tariffs, how much is it going to bring in terms of an inflation surge? And that's really the core reason why the Fed, to a large extent, hasn't been more aggressive in cutting rates, despite the enormous pressure that the Trump administration is instigating now on the Fed. So we're probably looking at potentially a third cut in interest rates before the end of the year, but very much dependent on how the inflation outlook just generally goes. Now, on top of that, I'm just going to flick forward to the outlook for energy prices, because fundamentally, one of the things that has probably been helping in terms of the inflation outlook, both in the US and in Europe, which basically buys about 10% of all of its household income, is spent on energy costs. Energy costs are substantially lower in euro terms. And obviously, and this is the driver. So if you actually look at where energy prices are today versus where they were 12 months ago, they're about 23% lower, but the combination of the euro getting stronger as we buy, effectively oil is priced in dollar terms. So that reduction in the value of oil, first of all, in terms of market price, and then second of all, the strengthening of the euro is having an offsetting impact from a European inflation, probably gives the ECB room to cut rates a bit further than we would have expected previously. And that's putting a bit of downward pressure on inflation expectations overall. So from an interest rate perspective, we're probably looking at maybe an extra cut in interest rates in Europe because of the fact that the inflation picture is starting to look a lot more favorable than it did. The difficulty that we have is obviously the tariff uncertainty, and obviously a significant tariff on Europe of in the order of 30% would be very damaging from an economic perspective, and that would feed through to probably the likelihood of the ECB having to cut even further than we're currently looking at. But really a lot to play out over the next even 6 weeks or so, before August 9th and what happens afterwards in terms of the deadlines that have been put in place so far. So an extraordinary backdrop to this, huge levels of economic uncertainty, huge level of interest rate uncertainty because of the way the markets are set up. So just in terms of being a bit parochial here, I know there's quite a lot of Irish exposed to this. Obviously, the big question in terms of the performance of the Irish economy, very, very strong performance in the first quarter, huge surge in exports into the US ahead of tariffs, so stockpiling. And obviously now we're going to see the impact of probably some false negatives as export figures, destock after that massive stocking that happened in the first quarter. So you probably get a couple of big negative numbers coming through in the Irish economy. That's probably not really reflective of actually what's really going on the ground. However, the risk is that we do end up in a regime where 20% tariffs and then further tariffs again announced later on in pharma, having a type of double impact on the economy over the next 18 months to 2 years or so. So real levels of uncertainty. However, from the perspective of ESG performance overall, so when we look at the sectors of the market that are very heavily tagged as ESG friendly, or the indices that are driven by ESG as a concept in the US up about 5% this year, compared to the S&P, it's actually tracking exactly what the US market is actually doing. Interestingly, there is a gap. There's actually the Euro Stocks 50 is up about 20% or so. ESG stocks in Europe are actually only up about 10%, better than the US, but not as good as the overall market. So there is a sense to a certain extent that despite what's going on at the moment, there is somewhat of an outflow from USG orientated stocks from a European perspective. Now, it could be sectoral mix as well, where in financials, different sectors are getting over and underexposed compared to these type of indices, but generally a bit of an underperformance from ESG stocks so far this year. So what's driving the major factors that we see in the markets at the moment? Obviously, a massive retreat in the US, federal retreat, and now it's a state-led ESG momentum now at this stage. Very significant change in the leadership in the US and their attitude towards ESG overall. Suspension of the SEC's climate disclosure ruling and a formal exit from the Paris Agreement, and ESG policy development has effectively devolved into a state level, resulting in a fragmented jurisdiction-specific landscape with varying degrees of ambition and enforcement. From a European perspective, it's interesting. Look, Europe is fighting back on ESG to a large extent. However, it's realizing there's a longer war that actually needs to be won here in terms of, I suppose, embedding the key concepts of ESG and climate change investing, social investing, and governance investing in a way that can actually be much more adaptable in the real economy. And that's one of the big rollbacks that we've seen is the omnibus package around CSRD, which effectively takes out a lot of the companies that would have been reporting in the lower tier. So the medium-sized companies are effectively going to get a lot more dispensation about what they have to report. And, we're still in a very uncertain period. This was announced in February. We'll get to the conclusion of this later on in the year. Second of all, the ESMA guidelines around Article 8 and Article 9 funds. So if you think light green funds for Article 8 and dark green funds for Article 9, they're tightening in terms of what the disclosure regime, the labeling of that. And we've seen quite a lot of migration between, funds that would have been labeling as Article 9 moving towards Article 8, and some leakage of funds from Article 8 into Article 6 where they couldn't satisfy minimum standards for being a light green fund. So there's a lot of stuff happening from a European perspective, but in a policy perspective, which I'll talk about a bit further on, Europe is definitely, is putting more stakes in the stand about its commitments to ESG. In the face of a very changing and challenging environment from a US perspective. And obviously the UK following a very similar line to Europe, explicit anti-greenwashing rules, stricter labelling and marketing standards around ESG labelled products, trying to focus in and probably to a certain extent in line with the EU type of promote more of a thematic ESG investing rather than a broad label of ESG, sectioning it out to actually what are people investing in within the ESG range of products. So the political pressure on ESG in the US is incredibly extreme, and will continue to evolve over the next number of months. Fundamentally, we're seeing defunding of ESG and SEC, Department of Treasury, DOE, repeal of a lot of Biden's ESG efforts last year, a removal of climate-related disclosures from public companies, undoing a lot of the SEC's work last year, promotion of fiduciary realism, which is basically barring ESG as a concept in terms of unless financially mandated, and a reversal of funding for solar, wind, and alternate energy. And in fact, if anything, tax breaks for coal in the one big beautiful bill. So an extraordinary reversal, of 180-degree reversal in the policies that we've seen under the Biden administration. And that's reducing, that's having a lot of knock-on impacts. We're seeing, in an individual state perspective, the banning of ESG and state pension investing. In Florida, in Texas, we're seeing blacklisting of financial firms that are boycotting energy investment. In West Virginia, restricted contracts with banks using ESG screens. And we've seen lawsuits in Utah and Louisiana against SEC climate rules. So, the legal environment that has emerged because of the fact that this administration is so aggressively against ESG as a concept is becoming extreme. So it's not, and again, I'm going to go on and we'll talk about this. It becomes effectively, ESG is becoming a legal liability for US firms operating in the US. Disclosure frameworks are being repealed. Global infrastructure bifurcation, we're seeing a big change around from what we're seeing in terms of the standards now that the US will have to meet compared to the rest of the world, and certainly from a European perspective. And then we've got a certain amount of a reversal of, a decade of progress in ESG is coming under attack under the current regime. And that has fed through to a number of different areas where there was a lot of cooperation. The Net Zero Asset Manager Alliance, we've seen a lot of big resignations there from BlackRock, from a number of different major firms, Vanguard, backing away from their institutional-wide commitments to ESG to a large extent. However, there is nuance in this, and I don't want to don't want to categorize all these firms in the same light. The largest, they're under a lot of legal pressure from a US perspective, and obviously they have to adjusting their cloth to respect that. And the implications are a lot of these coalitions are now becoming more fragile. There is, to a large extent, the regulatory focus now. To a large extent, a lot of the commitments that have been made under net zero would have been, to a large extent, voluntary. You could see in different regions now, particularly in the EU, more regulatory emphasis on instilling climate pledges and collective action in a much more vigorous way. So where commitments to voluntary schemes decreases, you could see a step up of the regulatory environment. And I think that's going to be a very important feature of both the asset management world and the banking world. We're also seeing a net zero banking alliance withdrawals. We've seen Goldman Sachs, Wells Fargo, Morgan Stanley, JP Morgan resigned from that alliance. A lot of the Canadian banks have withdrawn from that alliance. And, again, the political risk, banks targeted with anti-ESG legislation, investigations, lawsuits in the US and in Canada, regulatory uncertainty, fear of legal exposure from collective climate risk action, and strategic repositioning. So banks shifting to internalized net zero plans without external oversight. So there's a lot going on in the global environment from this. And what we're seeing also is that from a net banking alliance perspective, they've softened their membership requirements. So they've lost about 25 banks because of the push against ESG overall. But they have realigned to be more aspirational. So to a large extent, as a type of these type of big combinations of both in asset management and banking, where there's very strong commitments to net zero, they've certainly backed away from that, and they're much more weaker organizations or weaker momentum behind that. From a strategic perspective, it means investors and asset owners should be re-examine bank level climate risk exposure and commitment criteria from investors. As I said, voluntary frameworks are weakening. Market pressure alone is insufficient to maintain climate ambitions. And policymakers will probably, from outside the US, look to stronger regulatory frameworks in place of voluntary initiatives. So, if anything, as voluntaries pulls away, you will potentially see more regulations around setting of targets around ESG and setting of targets around climate change, because it hasn't gone away. And if you look at AXA Future Risk Report, the top risk in terms of the insurable global environment is climate change for the third year in a row, followed by geopolitical uncertainty, cybersecurity, and risk related to AI and big data. It is a major issue. And obviously, the other big challenge for ESG is how it positions itself. We've seen, obviously, a lot of ESG funds, as they're currently set up, would be type of not significant investors in the arms trade. And obviously, one of the biggest themes that we've seen in Europe over the last 9 months or so, given the pressure from the US and the obviously the difficulties that we're seeing in the Russian Ukraine situation, a massive step up in arms expenditure and expenditure on security. And what we have seen, probably to a certain extent, the potential that we may well see another category of funds emerge, ESG, which is basically where security is actually allowed within the label to effectively recognize the fact that their security, without security, environmental, social and governance issues are going to become undoable to a large extent unless we've got a secure border and a secure economic environment to be able to work off. And obviously that means that defense spending is going to increase very significantly over the next number of years. And if you look at the number of stocks that we have in ESG that are exposed to that trend, there's probably a question mark over future labeling of these products. So, and it is a bit of a divorce in reality. If you look at what's happening in the US, and you look what's actually happening on the ground in terms of the climate, like Florida insurance premiums up to about $11,000 a year per house, ignoring climate risk framework. We've seen extreme weather events, more hurricanes, more floods, deregulation, less reliance is the reaction from the policy. We've got climate stress within the federal agencies. You saw what happened in Texas there recently. Potential removal of climate mandates. Like, it's an extraordinary situation where we have the world effectively warming, getting hotter, more of these extreme weather events happening, and yet we have a complete reversal of policy and direction under the current administration. Extraordinary stuff. And Canada is probably a very interesting test case to see where insurance costs have gone. We have comments from Allianz in the last number of weeks saying we are facing into a world, if we continue with the type of damage that we're getting from these extreme weather events, where general insurance markets will become extremely fragmented, and the expectation that these type of assets will hold their value because they're insurable in particular regions in the US and across Europe and everywhere else. Once they're exposed to significant climate change events, they become uninsurable, and the general insurance market will have to fragment. And what we are also seeing is that big pushback that basically the asset owners are starting to retreat from managers that aren't able to show very heavy commitments to net zero overall. So we're seeing a lot of big mandates start to shift away from probably US into Europe to a large extent. So where there was a US manager shifting into a European manager, which is able to hold much larger net zero commitments overall. So, and we're seeing, and these are big numbers. We're talking about over 18 trillion of AUM is managed under sustainability oversight at this stage. And that money has been moving from US managers that can't demonstrate that long-term commitment at a corporate level to ESG goals and climate change goals, and where UK and European asset managers are stepping into that breach. However temporary that will be over the next while. So very quickly, I'm not going to go through every different area here, but we obviously I talked about the sustainable finance disclosures regime and the changes that we're seeing there. And we have seen obviously a withdrawal from the Article 9 funds, which are heavily green orientated, the ones that have a fund that has sustainable investment as its objective or a reduction in carbon emissions as its objective, to funds in Article 8, where a fund which promotes along other characteristics, environmental, social characteristics, or a combination of these, provided the companies in which the investments are made also follow good governance practices. So a lot looser regime under Article 8. Now, if you look at in terms of total funds at this stage, I'm just going to flick forward here. There's about 6 trillion in the ESG space in terms of Article 8 and Article 9. And obviously that's dominated by Article 8. We've got probably about 5.8, 5.7 trillion of funds in that regard. And of the total funds environment, about 60% of the funds that we see in the under SFDR are actually there's about 10 trillion of funds. About 40% of those are in Article 6, where there's no commitment to climate. And then 55%, about, as I said, 5.6 trillion or so in Article 8, and a very small proportion in Article 9. Article 9, there's a lot of work to be done around repackaging and re-understanding what type of funds we're investing in that area, and relabeling it to be able to make them much more investor friendly when investors start to pick. And that's where we're likely to see the emergence of much more thematic investing within ESG. So if you look at the big sustainable, responsible investment themes like clean energy, aging population, battery, climate change, innovation, future of food, electric mobility, social responsible world, forestry, you're likely to see a much more of a demarcation in overall funds into these explicit categories to make it easier for label, easier for investors to understand, and easier for money to be able to commit it to those really important causes when we look at the way that the global economy is shifting and the world ecosystem is shifting as well. Not going to spend much time on the omnibus package. Very disappointing to see this, but probably a reflection of the pressure in the European Commission to relax some of the rules that we have around CSRD to be able to make it more applicable to the larger firms. And but it's exempting about 80% of the firms under the new proposal, which would be really disappointing because ultimately speaking, the evolution that we've seen over the last 5 years is get the large companies to report. They then drag in the smaller companies that are reporting into them. And then eventually by 2027, we've got the smaller companies also reporting and understanding where their climate change impact is, their greenhouse gas emissions, and all then taking policies to improve their energy efficiency and obviously adopting both strategies right across E, S, and G. So disappointing, but the jury is not out here. Sorry, the jury is out here, excuse me. The full outcome we'll know probably back in October or later on in October, probably coinciding when we'll find out whether pharma is in or out in terms of tariffs from an Irish perspective. But finally, I suppose in terms of this particular section, it is a major setback, you would say, from a reporting measurement and a net zero alignment. But the pressure is increasing to act against the US split overall from our environmental commitments. So in one respect, Europe has loosened the rules, but on the other side, you could see another approach being taken to be that's much more pragmatic and more relatable and more applicable to realize that look, ESG is under attack. We have to bend and shape the rules to allow certainly a recognition of the fact that we're dealing with a real threat in terms of global ESG policy and climate change policy, because climate change, unfortunately, guys, it's getting worse. And I'm not going to just go through very, very briefly what we're trying to do in our net zero is keep temperatures below 1.5%, 1.5 degrees ahead of where they were in 1850. At the moment, our current policies are probably 3%, 3 degrees, and heading to 3.5 degrees with the US pulling out a lot of these initiatives. So we really are in touch with very dangerous land at this stage. Global temperatures could spike to over 2% for the first time in the next 5 years. Real probability that we're breaching 1.5 degrees already, and the likelihood of meeting those targets is becoming lower by the day. The imminent possibility of a 2% degree year, you can see they've shown two different time periods in terms of global temperatures and carbon dioxide levels increasing, methane investing, and nitrous oxide continue to increase in the overall energy mix. We're seeing global mean temperature for surface temperatures continuing to climb, measured by all the different bureaus at this stage. We're heading probably about 1.6 degrees. So the aspiration of keeping us at 1.5 degrees is becoming a much more difficult thing to see. And I think what we're seeing now is an adjustment to recognize that, if we beat 2%, we're probably in a, that would be the best that can be done in the platform that we're currently dealing with at this stage. Now I realize I'm going to be under a little bit of pressure on time here. So what I'm going to do is, we'll skip from the bad news on a climate perspective and probably bring it back down to, what areas do we need to focus on when we're dealing with emissions overall. And this is all stuff that you're going to deal with when we can talk about when we do the program together. How do you develop programs? How do we develop investment strategies around ESG that looks at emission concentrations? This is an analysis done of the overall equity markets globally. And you can see that basically when you work at the statistics, about effectively 13% of the market cap produces around 71% of our CO2 emissions globally. And you look on a country basis, you can actually isolate the different countries here. And China obviously producing about 31% of all global emissions, the US at 14 and Europe at 11. Europe as a standalone could only do so much here, but it has to stand up in a leadership role. I'm going to quickly go through some other major themes: electrification ramp up, all this very interesting stuff and noise that comes from the US about backing away from ESG commitments, yet diving after critical minerals. And that's what we need. Ultimately, the requirement for critical minerals, by 2050 is going to be basically a tenfold increase from where we're currently at because of battery technology, because of electrification, because of the use of solar, PV, wind, and needing to store that energy in different forms. And obviously that translating into the real economy. So Another big thing, the last thing I'm going to probably touch on is the European Performance Building Directive. One thing that looks like it's going to go ahead next year, it's going to be committed into, transposed into European, sorry, local Irish and European localized law. And that will require very explicit targets around energy efficiency in buildings before they're able to be rented out. So these type of, some of the big commitments that we have around the asset classes, they will continue to be very important. We haven't seen a relaxing in this, and this will set minimum targets for when buildings can be rented out to different corporate players or even individuals when we move into the mortgage stock, and the danger of stranded asset risk starting to emerge in different portfolios. And I'll finally stop on our last point overall. Okay, and I'll hand over to Louise here because she's just come online. ESG, challenged by name and legally, probably an opportunity to redefine investment and lending in ESG. Organizations which double down will benefit outside the US. ESG has become more thematic, more specific goals orientated around different major themes that we're seeing. Greater pressure on stewardship. So if you're inside the ESG area in terms of demonstrating that there's much greater stewardship to demonstrate that to investors. Much more difficult environment for the global players. Definitely needs two strategies, one inside the US and one outside the US. And the challenge that we're looking at now is not temporary. It's understanding the nature, the impact of the US administrative rollback. It's ideological as much as political, and that could be there for a long period of time. We could be battling to justify what's happening from a net zero perspective on a continual basis, and we need to get better at explaining that story to the population and to the wider masses. And climate change impact is accelerating, social division is increasing, and political governance is weakening under the current regime. So the battle, as I say, for ESG, we're only in the second phase. We had the first one, now we're in the second one, the real fight, and the challenge has never been greater. So really looking forward to the people that will be joining us later on in the year in the postgraduate diploma. We'll explore loads of different issues in this area. This is only a little bit of a touch point. There's massive levels of change to happen before we even start delivering this program, and hopefully we'll give you a very real and usable and practical up-to-date view on ESG and how it can be integrated into your investment strategy overall and integrated from a corporate perspective when we all meet later on in the year. Louise, will I invite you in?
Thank you so much, Kevin. Yeah, go on ahead, Louise.
Well, and apologies everyone. I got badly delayed. I think I'd said to you, Jane, I might be 10 or 15 minutes late, but I was a half an hour late and I missed all the good stuff from Kevin. But
We'll send you the recording.
I'll fill you in later. We'll fill you in later, Jane.
I'm always
Louise, sorry.
I'm always ready to hear what Kevin has to share, because if you feel you're really getting it fresh off what's happening out there, so it's great to have that input, and I suppose it is a good taste of what would come on the postgrad cert. Jane, I don't know if at the beginning you gave any overview of the program or...
I didn't. So we could do that for anybody that can stay on for another couple of minutes. And before we get to that, there is one or two questions that I might pose to Kevin, maybe before we let you go, Kevin. But thank you, first of all, so much. There was a huge amount of information there, and it was really great to get your expert insights. And the analysis. So there's so much changing in the landscape. We can see that, and with global shifts and changing US policies. So I know that's going to continue to change, and we look forward to hearing more, especially to those that can join us for the postgrad cert. I'm just going to go those one or two questions here. So somebody asked, considering the shift from the EU towards commercial alignment with Asia and China specifically, and with China's focus on sustainability, will this possibly alter the trajectory of the EU's approach in 2026?
It's interesting because there's no doubt, and it's one of the things that I didn't touch on, but China's been a massive leader in the adoption of wind and solar technology in type of offsetting its global emissions, and obviously exporting that technology then outside China. Europe up to this point has type of protected itself from cheap imports from China. As probably one of the things that we're watching at the moment is the EU looking at the EV market and saying they're going to restrict Chinese imports from China. So you know, there is this inbuilt type of protection of the eurozone and the European EU concept as a trade unit. But at the same time, we're probably going to end up in a compromised situation. A lot of the best technologies around and the cheapest technologies that we have around some of the alternate areas has been developed in China, and we're going to have to figure out how to adapt that into our longer term climate plans from a European perspective, because obviously the cost of production in China is still vastly lower for a lot of these key technologies than we're seeing in Europe. So I think it's a bit of a patchwork from a European Commission perspective in type of integrating the absolutes that we need from China in terms of the production and supply of some of these key components that we need in the renewables area, and also trying to, I suppose, instigate a significant growth in the technology capability of the European environment in this area.
Thanks, Kevin. Really insightful again. I have another question here that I can probably answer. Who is this course for? Well, it's for anybody who's working in sustainability or aiming to work in sustainability. I suppose like finance professionals, sustainability ESG managers, procurement leads or procurement heads of procurement, investment analysts, project managers. Yeah, it's kind of across industry. But if you're working with finance teams or you're on finance teams or working into finance teams and working on sustainability, I think this course would be very fitting for you, very suitable. Hope that answers that question. And do email me anybody, Jane Flanagan at tcd.ie, or Jane.Flanagan, I should say, at tcd.ie. I'll email everybody that has registered for the event afterwards anyhow. But do send your questions to me, and between us, we can answer them, I'm sure, over the coming days. Louise, maybe, yeah, we might get you to give us a short overview of what to expect from the course, if I've missed anything there, before we sign off for today.
And really, I suppose it will be a very short overview, Jane, because you covered a lot of it there. There are a lot of sustainable finance offerings in terms of short courses and postgraduate certificates and so on. And people might wonder, well, what makes this different? One thing I think that we will be focusing much more on what the company's needs are. A lot of the offerings at the minute are looking at it from the financial services perspective, but we are looking at those working in the company, gaining access to finance, what they do with the finance. As well, if you're gaining access to sustainable finance or using it, it's likely part of a sustainability journey. I know one issue that's come up a lot in the research we've done is managing that change, managing the transition to a sustainability strategy. Particularly, I suppose, amid a landscape that we've seen the omnibus announcement and various different geopolitical developments that we are questioning, is a sustainability strategy that the route to take? And our argument would be yes, it is. But how to navigate all of those changes. There's a lot of reporting, even if you don't fall within the CSRD net, there is a lot of reporting that still needs to be done. We talk you through that, and just ensuring that there's integrity, good governance and good internal control over how you use sustainable finance. And they'd really, I suppose, be the key selling points, as well as, I guess, what Kevin has covered with you today.
And there's so much in that. I'll have to digest that, Kevin. I'll be
Yeah,
watching the
actually,
recording
I've got a
back.
very interesting question, Jane. Somebody says, I'm not going to say who it was, says, any positive news? You know,
Yes.
so
Yeah.
there is. And the question is, you need to tune in October and later on in the year, and hopefully we'll have a very clear, a much clearer pathway as regards both the tariff regime and obviously where the battle for ESG is shaping up, because there's definitely big winners here in ESG on the other side. The ones that have doubled down in their commitment to ESG they've been seeing significant fund inflows. Banks have been able to double down their commitment to being benefiting from this. So there is winners or losers from an asset management and a banking landscape in this. And I suppose to a certain extent, we're going to see if we can navigate that with you later on in the year when you're on the program.
Very good. And the other good news, 50% funding for eligible applicants. And the eligibility really is around if your employer is willing to cover the balance and they're in the private or the semi-state sector in Ireland. I can provide any other information to anybody that is interested in maybe making an application, or if you just want to schedule a call to have a deeper discussion on it, please do reach out. Kevin, thank you so much again. Really appreciate your time today, for your really valuable and expert insights. And thanks, Louise, for giving us that overview of your program. Louise is our program director. Kevin leads out on module 3. The course will run 1.5 days a month in here in Trinity Business School from October to June. And then, yeah, you should come away with your postgrad certificate in leading and implementing sustainable finance. Guys, thank you so much for your time. I'll let you go and we'll talk to you soon.
Thank you.
Thank you.